welcome to another night of Block Talks. I'm so excited to see all of you here. It's always, I say this every week, but I enjoy saying it because I keep seeing familiar faces, some old, some new, and it's truly a testament to the fact that you guys find this valuable. So we'll keep it going for a few more weeks every Tuesday night at the Rose Hill. We're very happy to have the Rose Hill supporting us in spreading good knowledge and information to the community in New York City. So tonight's discussion for Blockhouse is on economics and governance as we think through the evolution of the tokenized world. It's a very important topic, one that I don't think enough people are talking about, which is why we really wanted to highlight and profile some of the key considerations that one should think through when they're thinking through a model for governance, economics, sustainability, fairness, and how you can use technology to support that in a decentralized or pseudo-centralized or centralized platform. And so today, I'm very happy to have two special guests with me who are in each of their own realms very knowledgeable and have a large amount of insights and appreciation for the space. To my left, we've got Kathy Barrera. She's the chief economist for Prysm Group. Kathy is not only just one of the most interesting people I've met in a while, she's a badass woman, and I'm very supportive of that. And she's a Harvard PhD, so that's very cool, in economics, and a former professor at the Cornell Business School. Correct. So welcome, Kathy. On my right, we've got Alexander Tsankov. Alexander is the managing partner at Cambrian Crypto. Cambrian is an investment firm for crypto investments, both ICOs as well as tokens that are in the liquid market.
We like alts.
They like alts. So Alex, has been a blockchain investor since 2012, former software developer, I guess current software developer as well, and now he's putting his money where his knowledge is and is an active investor in this space. So guys, once again, welcome. Our mission with Blockhouse is to spread great ideas, connect good people, and provide you a destination for accelerating your business. We are in the process of closing our round to launch the first New York City Blockhouse as a clubhouse, and our goal is to have 20 locations around the world, so that when you're traveling, you can plug in, learn, and meet amazing people. So hopefully we'll see you guys in South Korea, China, Singapore, wherever else we open. So let's get right down to business. Economics and governance. This is a really sexy topic for a Tuesday night right before a snowstorm. Why don't we work through some of the basics of governance? Kathy and I had the privilege of speaking before we started tonight. We wanted to make sure that everybody is on the same page. So let's just understand who's in the room first, right? Who here is someone who represents a company that is building a protocol? Wow. Okay. And what about somebody who represents a company that is using an existing protocol to launch a token? Okay. What about somebody who just loves the space and invests in it? So we've got some investors in the room. Great. And what about those of you that represent an industry that is considering using the blockchain in making their business more efficient? Great, so it's a healthy balance. Kathy, when you think through some of the basics of governance, what are the important elements of governance that a company should think through as it relates to the blockchain?
Okay, I have a mic. So I think that the first thing that you want to think about is the structure of the blockchain itself, and whether it's centralized or decentralized, or sometimes called permissioned versus permissionless. So if you have a permissionless system, this is one and many of you might already know this, but for the folks in the room who don't, this is a system where the miners or the people who are producing the blocks and maintaining the blockchain can freely enter that role. Versus a permission chain where you need to have permission from some authority or the owner of the technology in order to become a block producer. And this has really important implications because it tells us a bit how the chain can evolve over time and who is going to be able to have input into how it evolves over time. So governance itself is really just the system of rules or structures that we put in place in order to determine how the chain is evolving over time or how decisions about this technology need to be made over time.
So Alex, when you think about investing in a company raising capital, what are the key governance items you look for to make you more comfortable with your decision?
So I would say that the most important thing is, first of all, to understand whether or not they have the ability to actually create the product that they're talking about. So if you look at the original Bitcoin project, you had one developer, Satoshi Nakamoto, and that developer just created an initial version of their product, and they just put it out there, and you could start mining it and working with it. And it was only after it had worked for about maybe 2 or 3 years that people started saying, oh, okay, well, I feel comfortable investing in that. So I kind of bring a similar approach to what I find to be useful companies, which is my first criteria is, do they have the ability to actually make the vision happen? And that's the first set. And then second of all, if they do have that ability, do they have their incentives aligned in such a way that as an investor, I will be able to make a return on that? So those are really the two things I pay attention to in terms of governance.
Great. And so when we think about achieving good governance and aligning those incentives, what are some of the key tools or considerations, Kathy, that one should think about to ensure that the ecosystem is behaving how one would want it to?
I really approach this problem from what I call a first principles way of dealing with these kinds of decisions. So what you really want to understand is what are the types of decisions that are going to have to be made as the system unfolds. And so really, governance is important because we can't specify in advance all the contingencies that might happen over time and what should be done in each of those contingencies. So we need a system that tells us how decisions should be made as more information becomes available over time. Now in the traditional corporate world, the way that these problems are dealt with is by setting up a board of directors who will choose a CEO, and that person is going to be responsible for most of the decision making, and anything that is not going to be sort of overseen or the specific responsibility of that CEO will then fall back to the board of directors to decide. So it's a system that can account for all possible contingencies because you don't have to specify every contingency. You can just assign the decision rights to a particular person. So this becomes much more complicated in a decentralized system, right? You can't just put one person in control of a decentralized system. So instead, we need to figure out how to make the rules about, say, who is going to have input into these decisions. How is that group going to come to some sort of consensus, or what voting rules should be used to determine how that group comes to a final decision, right? So you want to start with, what are these decisions? So in some cases, you might require experts. In other cases, you might want to rely on the preferences of the community that's using the platform. It's really going to depend on the particular use of that blockchain. And you want to build a system, a structure that is optimal for that set of decisions.
Yeah, I think that was a wonderful answer, Kathy. One of the most interesting questions that I was sort of asked over the past couple of months was, I was at a party and someone asked me, what do I do? And I said, during the day I work at a Bitcoin exchange. So I said, well, I work at a cryptocurrency exchange. And she responded to me, she said, well, so do you work for Bitcoin? And, at first I thought that was a funny question because I was like, oh, does she mean I get paid in Bitcoin as my salary? And I said, no, I don't get paid in Bitcoin, I get paid in dollars. But no, she was actually asking me, do you work for Bitcoin, the company? She thought that Bitcoin was a company. And it's kind of funny at first because we're all in this space and we know that it's not a company. But it really got me thinking, actually. I mean, in a sense, Bitcoin has become a company where there are investors, there are people that are creating Bitcoin software. And me as a member of a cryptocurrency exchange, I have an incentive to create systems that allow people to turn US dollars into Bitcoin. And I make a salary based on Bitcoin having sort of value because people want to turn dollars into it. So I thought that was a really interesting question because in a sense, when you work for an exchange or you really work deeply in this space, we do kind of work for these blockchains as companies. And when I think about governance, I think about where are the interactions that we have with these products that are different and new than traditional relationships with organizations like a company or a partnership. And I think it's a fascinating question to ask ourselves, which is what is the degree to which we are employees of an open source project when we're actually developing on top of it?
So on that note, not only are we, what is our responsibility as employees in that project, but also how do we govern that project survives, adopts, and innovates so that it stays relevant as technology changes? And a key question mark with Bitcoin is commonly asked, if it keeps forking. How is that supportive of the technology? Was it that it was lacking a governance model in the beginning to stop it from doing that, or is that the evolution of being open sourced?
I think that it's an amazing development. I think that every fork that comes out, like the idea of forking is something that's very new. We've never had that as an economic possibility. We can't, for example, say, oh, well, we dislike Facebook. We're just going to fork it and create a version that shows our news feed with only pictures of our friends. We can't, yeah, I mean, that's one way. But we can't do that. We just simply can't because we don't have access to the data. We can't just duplicate what's there. But in the case of like Bitcoin, for example, well, there were some divergent interests. There were some people that still believe that, it's unsafe, for example, to, make large blocks because that centralizes power. And then there are other people that believe that creating large blocks are good because it increases the throughput of the network and that the goal of the Bitcoin network is to do transactions instead of be a store of value. So it's a debate. And there's no right answer to that debate, but the beauty of forking is that both sides can kind of go their own way, and we let the market decide what it sort of believes in that debate. And given enough time, I think in like 10 or 15 years, I think that a lot of the forks are just going to disappear. They're going to die in the same way that organisms evolved in the past and then disappeared after a couple million years. They were gone, and the ones that really survived and provided something of value will continue going and getting stronger in the process.
I think that's really interesting, if I may build off of that. So I think an important question that we need to address is whether there are really two underlying groups that just have fundamentally incompatible preferences over how a system like Bitcoin runs, or whether we're having a problem coordinating on one solution. And I think it's very difficult to tell from what happened with Bitcoin, which of those two scenarios we're in. And one of the things I think that governance can do well is provide a mechanism for coordinating on a solution. Now, it may still be that some subgroup decides, we'd rather have our own system different from what the majority is doing. But by providing a set of rules or a process for determining how changes can be made to the system, then you have sort of a focal point for what is the legitimate change or the change that we have basically agreed to by adopting this technology in the first place.
And so that leads me into voting, right? How do you decide who votes, how they vote, when they vote, what's worthy of a vote? How do you, and obviously each ecosystem is different because the outcomes of what those ecosystems are trying to achieve are different, but like, what are some best practices that you've seen through different token offerings or white papers that you've reviewed?
So when it comes to blockchain voting, the earliest example is, of course, Bitcoin. And the way that Bitcoin worked is it's pretty much one CPU, one vote. So the more hashing power you have, the more voting rights you have. And that is because the protocol builds into it this system where the longest chain is considered the correct one. So that's, there's a lot of academic discussion as to what actually is Bitcoin because it goes through all these forks and changes. Well, some people believe that it's simply the longest proof of work chain. So that's one way of voting. I don't think that's a very good system because it gives a lot of control to people who are able to build, a factory with a lot of ASICs inside of it. Now, the Ethereum proof of stake, which is being proposed, changes that. They say that you have a vote proportional to the amount of ether that you have staked. So that's an entirely different sort of voting protocol. And we can go even further than that. There are some of them that are attempting to be just simply one token, one vote. That's one way of going about it. There are some that are attempting to do quadratic voting. So that's the idea that one token is one vote. But if you want to, let's say, put in 2 votes, well, then that'll take 4 tokens. And if you want to put in, let's say, 3 votes, well, that'll take 8 tokens, stuff like that. So if you care a lot about something, you can put a lot down, but you don't have to worry about bigger players being able to completely swing the vote. So there are all of these sorts of questions as to what is the best voting system. And part of what excites me so much about blockchain and about what we're doing is that we're actually going to get very clear answers as to what very effective voting structures are within a business context.
There's actually an area of economics that could be very informative to this discussion. So we generally see voting systems under 2 contexts. So either we're trying to aggregate disparate sets of preferences and come up with one decision to represent that large group of people. Or, and usually it's an and/or because most real-world scenarios involve both, or we are trying to, we all have the same preferences, we all want to accomplish the same thing, but we're trying to figure out what is the right answer in this case, and given that none of us have perfect information, we're going to use the group to be able to figure out what the right choice is. So juries are an example of that. Everyone agrees that we want to convict guilty people and that we want innocent people to go free. We just don't know whether this specific person is innocent or guilty. So we're going to use a voting system to try to clear that information out. That's sort of a different philosophy from why we vote for politicians. Because we have different preferences over what kind of policy should be instituted. And in fact, voting for politicians incorporates a little bit of both because we may have agreement on what we want the ultimate outcome to be, but we have disagreements about which policies are going to get us there. And I think it's really important to keep this in mind because until we have identified what it is that the voting is supposed to accomplish, it may be very difficult to determine what voting system should be used. So for example, in juries are unusual in the fact that their vote has to be unanimous, which is in contrast to a lot of political voting where you just want to get a majority.
So I guess 2 questions. Do tokens and coins have voting abilities? If so, what are they, or how do you? What are some examples of them, and why is it important to incorporate them?
So that's actually, it all depends on how the token is designed, whether or not you have voting. You can entirely, because you can prove that people own tokens, you can say, okay, well, if you own 5 of them, then you get 5 votes. So there is currently voting on the blockchain. And I personally like to own tokens that give me voting rights, because what I've seen is that there are projects that will create these tokens with voting rights, and the creator will create these, put them out there, and then people who've acquired a lot of them will literally start contributing to the project. Nobody told them what to do. Nobody said, hey, we need this. Nobody, even thought that it was necessary. But people were incentivized because they knew that they had voting rights to contribute to that project. So I think that I personally, as an investor, I always love to own tokens that give me voting rights, because it gives me a sense of control over how this project is going to be run.
Also, if it doesn't have voting rights, there's certainly incentive-based structures in order to encourage the mining of those coins. When we think about the protocol layers, can you guys comment on how incentive-based structures work for the growth of these protocols?
Sure, and I actually think the two things are tied together. For protocols themselves, specifically for permissionless protocols, where miners have to opt into the system, they have to be compensated for the computer power that they're going to use in order to maintain the blockchain itself, right? And so most of the blockchains that are currently running offer rewards for when miner adds a block to the blockchain. And those I don't think that anyone has figured out what the optimal reward should be or should look like. So Bitcoin itself has a particular a reward function that decreases over time, and other blockchains work slightly differently, but you could envision a system in which the users of the blockchain or token holders could vote on what those rewards should be, and that could be something that changes over time, for example, as energy consumption costs change. So that would be one example of the interaction between the incentive system and voting.
Right, and while it's not voting, even how you get a block prioritized over another block, there is room for kind of an aggregate voting or a collusion in Bitcoin right now, right? Like, in order to move those blocks faster than other blocks, if you have more more buy-in in terms of the stakes that are being created, correct?
Yeah. Do you want to?
Yeah, so you're referring in a sense to the fee structure of how Bitcoin works, which is actually fascinating, because if you really dig into it, I learned this a couple months ago. When you're paying fees to miners, it's not actually that you are, choosing to give them that. You're basically telling the miner, mine me a block which sends this much money to this person, and you're sending them less money than you originally put in, and that little difference is being left to the miner. And that sort of way of working is something that creates entire markets on top of it, where miners have a choice. You can technically mine empty blocks in Bitcoin, which is sort of a huge problem, or potentially a problem in the future, where you don't include any transactions and you just collect a block reward. So there's a number of different sort of systems that you can have for prioritization. Personally, my favorite one, and one that I really hope to see Ethereum adopt in the future with proof of stake, is sort of a burn model in which you have a finite number of tokens, and you can get higher priority if you promise to burn more of them for a transaction. Burn in air quotes, because it would actually be far more energy efficient than another system. But it would be good because it would put a deflationary pressure on the cryptocurrency. So, just as like an aside, cryptocurrencies that involve generally like burning methods, I think that they're going to be very effective in the future, because it's just a good incentivization structure for new blocks.
Yes, I think there is, and I think that that is something that quite a few ICOs are trying to do in 2017 and 2018. That being said, I think that so you have a system where part of the product is also the vehicle for getting funding for the development of the project itself, and so. I think that, again, like with the governance systems, there is some experimentation around what models are going to work best, but it's unclear that we have come across the best possible system. And I think when you're operating in a market where the pool of funding is and the funders themselves are interested in very high return projects, it's going to be very difficult for a particular startup to say, I'm gonna forego all of those people who want to see the price of this token skyrocket, and instead I'm going to not put a cap on the number of tokens sold during my ICO. So I think that there's some feedback in the system and in the market for funding these projects, where in some ways the startups themselves have to do what the investors want to see in the market.
But if you think about it, right, if the demand continues to increase and the marketplace of that ecosystem is growing, then the pace of that supply can also be a lever rather than just creating a ultimate restriction of that supply, right? So if you look at different marketplaces, we don't necessarily, it doesn't have to be black and white. Can you give us examples of where not restricting supply can also create value for everybody?
So I absolutely think that not restricting supply can create value on a platform that uses a token, for example, to facilitate peer-to-peer trade. Right. I think that the issue is that a lot of times the developers who are creating that platform want to basically pre-sell the product in order to fund the development of that platform. And they're facing a market of retail investors who have seen the skyrocketing prices of these tokens and think that it's a chance for them to get in on the ground level and have super high returns on those investments. And so I think, unfortunately, and there was an example a couple months ago, a startup called Winding Tree. They did they called it a token generation event, I believe, where they didn't have a hard cap on the number of tokens. They said, we're going to sell each token for X number of dollars, and we're going to sell tokens to all comers during this time period. And unfortunately, they missed the mark on what they wanted to raise, and I think that's because those potential investors saw that that this project wouldn't generate the kinds of returns that other projects that are available on the market might generate.
So the question is, regardless of what they think they could generate, are there models where you could do really well as an investor in a token that has unrestricted supply? I know you mentioned if it burns it, that helps. What are some of the things that you think about when you look at companies or tokens that are not restricting the supply of their units?
So I can just think off the top of my head of, the most successful ICO that there's ever been, which is actually Etherium. So most people tend to forget that Etherium itself was actually an ICO. There's currently about 100 million of them out there, and 50 million of them were actually created and sold when Ethereum was released in 2015, and the rest have just been mined along the way. So I think it's just for us to all keep in the back of our mind that whenever we hear about this, ICOs are horrible, ICOs are just scams that take people's money, they're bad. Well, Ethereum was an ICO. And you can look back actually at Bitcoin. 1 million of them were mined by Satoshi, potentially by accident. Some people say on purpose. it's sort of up for debate, but 1 million of them were mined before it actually started picking up traction and he released it. So you could argue in a sense, well, he, allocated some for himself. And currently going back to uncapped supply, Ethereum is uncapped itself. There's no actually hard set number in the code as to how many of them there will be. There are some reasonable assumptions that we can make about growth and say that, well, it'll approach this sort of asymptote, and so we can operate on that assumption. But it's actually technically not capped at all, so it could keep growing infinitely. It's just that there's such a demand for it because it actually provides a service that demand causes it to have value. Because if I want to execute a smart contract, for example, it doesn't matter how many Ethereum there are in the world, I need to pay my gas fee somehow, so I got to buy some. And that'll go back into the pockets of miners. So that's a perfect example of an uncapped cryptocurrency that is still able to, maintain stability.
Yeah, I think just building on that a little bit, I think it's so we need to understand more from the SEC and other regulators which aspects of this they deem to be problematic, right? So while it is true that that over all time, Ethereum is uncapped. At any one point in time, the supply can't increase just to meet the demand. So we will continue to have that upward pressure on the price, and so it's unclear whether that's what the SEC views as being potentially problematic.
Very interesting. If we switch gears to the people who created blockchain, the technologists, they were solving problems that existed in the real world and providing an opportunity for decentralization, trustless environments. Trustless is an interesting topic because as much as we like the idea of transacting in a trust-free environment where trust isn't necessary because a smart contract is so smart, how smart is it right now?
I think that you're making, you're hinting at something that is really important, which is, let's just drop this idea, this word trustless for everything. It's so silly in my opinion because we trust a lot, okay? I mean, just because you bought Bitcoin, you probably didn't go through the source code and actually confirm how it works and whether or not there are actually 21 million of them and all this stuff. Like,
How many people did in the room? How many people have looked at the code of Bitcoin? So we're looking at half.
Did you guys look at the code before you invested? Well, that's really good, actually. That's some good due diligence. But I've developed on Bitcoin myself, and I have to say I got into it long before I actually read the source code, and that was because I knew very smart people who told me that this thing is interesting and it has this properties, and I, paid attention to it for a while, and I noticed that it followed those properties. So I just sort of assumed that it's doing what I think it's going to do. In the same way that people say that there's, a maximum speed of light. I don't know how to do it. Insider information. Yeah, I mean, reading the source code. But yeah, so there's a degree of trust that we have to have. I think that what's important, though, is that when we think about trustless, what trustless means is that it's possible to derive a conclusion from something. So the facts are out there in such a way that if we had the training or if we had the expertise, we could determine how they worked. So personally, before I put any money into a smart contract, I always try to take a look at the smart contract code itself. I mean, I can't necessarily, discern everything that'll happen and what the entire control flow is, but I do have some heuristics in mind about, well, is there a very easy way for an administrator to just pull all the money out of this contract? So when people say trustless, they need to sort of refine it to say there are varying degrees of trust. There's trusting something because you're told by, somebody that's, a lot smarter than you that this thing works. There's trusting things because we look at it and we see a lot of market value put into it, and that's evidence of the fact that it might actually be doing what it's saying. And then there's trusting it because we can go through every line of code and actually confirm how it will work. So there's a lot to trustlessness.
I think that it's important to remember. So if we believe that this technology is going to change the world, which I do, then we have to believe that this technology is going to achieve mass adoption. But because we live in the industrialized world, we live in a society that runs on an economy that requires specialization, it must be the case that a very large portion of the population is not going to have access to the skills and expertise that's required to interpret the code and be able to determine that it is trustworthy. And so you have to have some sort of institution in between that is facilitating that trust of that mass, to facilitate that mass adoption.
And I'll also add to that, what are we trusting? Are we trusting that the contract as it's written will be true, or are we trusting that it will be able to accommodate all the ifs and ones and the buts that will ultimately come up as it's governing those, right? How do you actually think through, or what would you guys say are some best practices you've seen in creating contracts that can adapt to unique scenarios that might not be advanced predicted into the contract?
Yeah, so what he was saying, that he believes that trustlessness boils down to the fact that there's no central authority that you have to trust, or that you have to, accept what they're saying. Which I think is true. It's a good point.
But in the end, most people have to trust someone, right? And all just trust each other. Can we? I think, right. So,
decentralization, though. That's why it was designed in the first place. You wouldn't have to trust anybody. The person who wrote it.
So, right. So, yes, I think absolutely that was the reason that it was designed, and that was the idea of the original community who contributed to this technology. But the original community themselves were people who are highly skilled in their capabilities to utilize this technology and read this technology. And I think it's important to understand that there is a very wide gap between that group of people and the average person in America, or particularly in the developing world. And so if what you expect to happen is for those other average people to adopt this technology, then you have to appeal to those levers that are going to cause the average person to trust this system. And I think that that's a non-trivial problem. It's going to be the case that a large portion of people, if we think that this technology is going to be adopted on a mass scale, then a large fraction of the people who are using it are not going to be capable themselves of reading and interpreting the code. So there's going to have to be some set of institutions implemented by these projects, by the community, in order to facilitate the trust of the average user.
Yeah, I mean, people don't. Yeah, what I think is going to happen is that trusting another individual, requiring that individual to not have to prove to you and derive exactly why something works, is a fantastic shortcut. Okay, you can gain a lot of efficiency by just trusting somebody, just saying, I know if I turn my back to you, you're not going to take my wallet. So that means that I can leave a wallet, on the table when we're running our business. So I think that what we're going to see is that there's going to be, there's going to be organizations coming out. There's going to be a lot of self-regulation of the ICO space where people are going to be like, okay, these are trusted individuals who are going to vet smart contracts and are going to say smart contracts either A, are secure, B, following best practice, C, doing what they say they're going to be doing, D, following the right governance practices, etc. And even though people aren't going to understand that, they're going to look at that seal and they're going to be like, okay, that organization has steered me right in the past. And they're going to do what that organization says. And it's not because they're dumb. It's simply because they're taking a shortcut. They're expending less mental energy than the person who has to spend all the time going through the contract themselves. And here's the thing, too, is that people that think that they can do that a lot of the time, in my opinion, you might potentially make a very bad investment decision if you're doing your own security analysis, because you don't know what you don't know. So there is going to be a need for organizations that are going to come out. And if you don't want to use them, well, then that's entirely up to you. The beauty of it is that there's going to be a choice. So you can read the Bitcoin source code, or you can just trust an organization.
So the remark is that when you're actually putting these assets onto the blockchain, providing a system that enables us to transact is a benefit, correct?
It's a benefit, and I don't need a third party to transfer 1 Bitcoin to you, for
Right.
example.
So the
But
elimination.
you do trust the protocol itself to execute that, and for you as a well-versed technical person, that doesn't require a leap of faith. But you could see how, for someone who is not technical, it might.
Well, and also, and this is where the beginning of this question started. A trustless system works if the people building the system are truly building a trustless system, right? How are they asking all of the right questions to make sure that the code works? How are they going to adapt the code for unique opportunities or ways that people might game that code to further their benefits and interests? What are some of the things that, being a non-technical person, you could ask to ensure that there might be the right level of thinking going into that code?
So one of the projects that I think is the best in the space is the MakerDAO project. And they're connected with this organization called DAppHub. And the idea with DAppHub is they create completely free and open source software, which is of use to Ethereum developers. And one of the things that's really interesting is that they're releasing, along with one of their models, a proof in Haskell of how this works. So for those of you that don't know what Haskell is, this is what's called a functional language. It exists sort of in a different computational paradigm than other traditional programming languages. And one of the benefits of these languages is that you can prove certain things about the code. You can say that the code can only be within these potential states. So that's an example. I mean, that's an example of some of the tools that you can use to see whether or not a project is, provably correct. But in all honesty, I mean, that's a very high bar to go for a lot of teams. I mean, when
That's a general direction that blockchain is actually going to evolve in, right? It's the evolution of functional languages.
Definitely. I mean, there's a lot of excitement in the space about functional languages, and I think there's a lot of questions that need to be asked too about whether or not we're giving ourselves a sort of a sense of a false sense of security by using these. We sort of, as I said, we don't know what we don't know, and we're allowing these languages to sort of lull us into a, trust of the language itself. So there's a lot of questions, but at the end of the day, there's a degree to which you just have to look at it and you have to say, okay, I look at the development team, I look at the incentives of the development team. Chances are they're not going to put within the code a ability to run off with all my money because they have reasons to not have to do that. That to me is the most important thing. I always look at incentives.
Great. Now let's switch gears to some of the. Sure. One more question.
Just got a quick question I pose when we talk about, if we take a step back, talk about voting, there's a lot of different sophisticated ways of voting, but I think there's also a trade-off between the utility of that token or that ICO or that altcoin versus how much people are really pushing for voting rights. I mean, we see that in public markets. You don't get any voting rights, but you really want to be part of security, so there's trade-offs, people willing to give up some voting or influence. We talk about institutions. Are we really fooling, this more for Kathy, are we really fooling ourselves in talking about trustless or decentralized? Would it be possible to characterize this as maybe institutional renewal? Whereas we believe in our institutions, at the end of the day, even from an economic perspective, if everyone has to look at the source code and everybody has to do their own due diligence and everybody has to for thousands of coins, I mean, we'll all be stuck in due diligence forever. You're going to have to start to trust other things, other institutions, for this to work, for this to scale, for this to gain efficiency. So is it possible to call this institutional renewal instead of banks, some other institution, if you will?
Sure. I think that this. Oh, I'm sorry. Yes. So the question is, should we think of this as a time of institutional renewal, in sort of adapting from what we saw during the industrial era to these new technologies that we're seeing develop now? And I think that that's absolutely accurate. I think basically this is a technology that is enabling new institutional forms, new ways of coordinating behavior between large groups of people that weren't possible before this technology became available. And therefore, we're going to have a wider breadth of possible institutional forms than we had previously had. That being said, it's unclear at this point that that sort of like this, that these new forms will be the optimal form for every possible application. And it could easily be that this is the best way to do it for some industries, some types of businesses, and the traditional corporate format might work well for other types of applications. And one thing that I would just point to quickly is that if you look at equity in the stock market, you see that there are some industries and some types of businesses that don't do well once they go public, because having gone public provides a completely different set of incentives to the leadership and the decision making at the top of those kinds of businesses. And so I think that what we can learn from that is that maximizing market cap or providing strong incentives for equity maximization isn't the right way to do it for every possible business or every possible industry. And so I think those are the types of questions that we need to start asking about applications of the blockchain. What is the best way to maintain this system, and what types of issues are going to arise that will have to be tackled down the road?
So the question is regarding delegated proof of stake, whether or not that provides an additional layer of credibility or efficiency in the decision-making process.
I think it's a very interesting innovation, and that exactly as I said before. So my approach would be to start from first principles. What is a set of decisions that's going to have to be made for this particular platform? And what is the best way to make those decisions? How can I structure a system to ensure that decisions will be made in that way? And I think that you're absolutely right, that this is, again, sort of an innovative way of dealing with choosing decision makers and allocating decision rights within this kind of system. I think it's very interesting, sort of like the example you gave of the possibility of a Warren Buffett, right? So in that type of environment, you need to have information clearing systems that can help people gain reputation and keep reputation so that it can be publicly available to everyone. So if you are creating a delegated proof of stake voting mechanism without that kind of information clearing mechanism, you're going to have a problem, right? So the system needs to be thought of in a very holistic way, and designed, not instead of winging it. Let's try to think carefully about how to create these systems.
Well, if you take a step back from blockchain, AngelList has been doing something similar, where an investment professional can lead a syndicate, and you can jump onto their syndicate and invest alongside that individual. So there is a layer of this happening in the non-blockchain world. Yet, even we know with AngelList, they've created their own coin, which we'll see what they develop with that. But they see an application to further that transparency through the coin. The next question, oracles. So we're talking about voting, incentivization, but the authenticity of the data is also very important. Otherwise, it's garbage in, garbage out, right? How do we create structures from an economics and governance point of view that adequately incentivizes and keeps are oracles correct or true?
Sure. So I think this is going to be one of the big challenges in order to broaden the scope of what this blockchain technology can be applied to. So in my PhD, I studied a field of economics called contract theory. It's a very narrow field. There aren't a lot of people there. However, I think it has some very interesting insights for blockchain. So, for example, the thing that is interesting about contracts in economics is that they are incomplete, right? If we could write every possible thing into the contract, we wouldn't have to worry about who's making decisions. And so we really think carefully about what types of information can be incorporated into a contract, what types of information will be enforceable in a contract, which means that it has to be the kind of information that can be observed by a third party. And the fact of the matter is that there are many types of information that this just might not be possible for. So I think that currently smart contracts are applicable to sort of a very narrow set of transactions. And if we can improve information quality and the ability to digitize information in a wider breadth of applications, we might be able to expand that. However, I think that there will still be a very large swath of the type of economic activity that we see using traditional institutions that will be very hard to duplicate on the blockchain.
Yeah, and just for a little bit of background for people that may not be familiar with what like oracles are. So that is like if we have a smart contract between us that says if my house burns down, then pay me money, like an insurance contract. Well, how does the smart contract actually know when the house is burned down? Like there's no way for it to get off the blockchain and actually figure that out. So what you have is you have an oracle, which is your smart contract says, all right, well, this thing can tell me if the house burned down. And I think that what we're going to see is there's going to be an oracle business. They're going to be agents. So when we write that contract, that insurance contract, well, we're going to allow as an agent the local fire department. And if the local fire department, let's say, starts making a lot of fraudulent claims, that's going to be very clear in all the smart contracts that are going out. And I think that the market on its own would be intelligent enough to say, all right, well, we're not going to use that as an oracle anymore. And we can point to this example, and this example in which they falsely claimed something. So it's kind of funny because like I get this as a criticism a lot. Like people say this on the internet about Ethereum, and I've never met anybody in real life who actually had the nerve to say this, but they're like, oh, well, what's the point of smart contracts if someone can just lie about the oracle? And I'm thinking, yeah, anybody can lie about the oracle, but once they do that, people aren't going to include them in the smart contract anymore, all right? We always have to have a degree of, faith that something in the real world, when people are recounting it to us, has actually happened. And the system is intelligent enough that people that are scamming doing that, they're going to be found out pretty quickly. And it's going to be very clear who did it. So I think that the oracle system is actually a really fantastic sort of development.
Just so everybody heard that, it's called the ZAP, right? ZAP token, a token created in order to create better incentive structures for oracles to be honest and provide actually kind of group-sourced feedback on their honesty and their level of trust. Look, I mean, that gets us back to the reviewing system, right? We found in the last 15 years, writing reviews is no longer a transparent system, and people figured out how to game it. And so if there's a way to provide better transparency on who is actually honestly reviewing one another and who is actually a true reviewer, I think there's real opportunities to evolve and provide better information in this system in the back end.
Is there such a thing as a consensus oracle? More than one source?
Yeah, I think there are. I think you want to comment on this?
Oh yeah, I mean that's actually the direction that things are going in, where you have like a number of them that you've chosen between, and there's some technique you can either randomize, so choose one of them randomly. You can medianize. You can say of all of these, choose the middle of it. One thing that was really interesting was actually in 2014 when this earthquake happened in Japan, and there was these cases of these nuclear power plants that were, that had meltdowns and introduced some radiation into the environment. People were talking about how much more effective the detection of that radiation was because there were so many little decentralized nodes that were able to contribute their own detection, and people that were able to average together all of these decentralized nodes, some of them not very well trusted, like they could have just been small universities setting up a Geiger counter. Some of them very well trusted, like national governments who were reporting on it. What they discovered was actually building a network of the ones that were supposedly less trusted was actually far more accurate than relying on the single individuals, specifically individuals that had an incentive to not be as honest about the extent of the problem. So when I think about oracleization, I think that what's really interesting are the ones that attempt to spread it out over as many different oracles as you can. I think that's where you're going to get the best results.
Great. Let's switch gears to smart contracts. How can we think about adopting and evolving smart contracts to provide for better governance in economic and incentive situations? Have you seen some examples, or can you share examples with the community here on what you think is interesting in some recent or older offerings?
Yeah, so the type of smart contracts that I'm personally interested in are not the contracts that reinvent the wheel, but rather the ones that allow the wheel to run a little bit more smoothly. So I generally look for contracts that take a problem that I know, that I understand, that already have a profitable business built around it, and then just attempt to optimize one part of that problem. So the most interesting contracts that so far that I've actually found have been a lot of decentralized exchange contracts. So this is a very clear-cut use case for a blockchain application, basically a marketplace for people to swap ownership of multiple digital assets. And I've been fascinated to see the growth of all of these different exchanges offering different incentive structures, different listing requirements, different advertising techniques, different API strategies, different fee structures, etc. And they make it entirely open to token holders. What do you guys think is the best niche for us? What do you think that we could be doing better? So those are the type of things that I'm very interested in.
So if I might digress a little bit back to what we were talking about with oracles, but I think that so it's an interesting application that you bring up in the decentralized exchanges because all the components going into that smart contract are blockchain native, right? So these are things that are super easy to verify, and it makes sense that they're the first working applications of smart contracts. And I think that when it comes to other types of information, we discussed a few examples where one example is trying to verify a true outcome. So in the case of the nuclear radiation, that this is a true state of the world that could be observed if you were on the ground somewhere and had the right measuring tool. And I think that, so these types of possibly public information that could be observable and verifiable are different from other types of information like the house burning down that you talked about. So we might be able to verify that the house has burned and is no longer there, but it's going to be a lot more difficult to verify whether it was arson and the person burned it down themselves or whether it's truly an accident. And so when we're relying on information from sources that are potentially biased, And you brought that up with respect to the nuclear radiation, but I think that it's important to keep in mind that we have to generate the right incentives, and we have to know what kind of information we're trying to develop and clear in the market. So I think that there is a lot of risk for censorship, information hiding, hidden actions that could potentially be problematic for a lot of these use cases. And those are issues that we need to work out in order to be able to have functioning smart contracts in these other applications.
Let's get into the question of consensus. There's been a lot of information provided recently that even with Bitcoin, if enough miners come together, which block is added to the blockchain can be influenced. So how do you govern for true consensus when if it's decentralized but people know who holds the power could come together again and provide collusion?
Sure. So I think this is why we have a number of consensus protocols that already have been developed and a number that are continuing to be developed. I think perhaps we have not come across exactly the right solution, or it may be the case that there isn't one right solution, but different solutions for different contexts. I think that different groups who have been developing these different protocols have sort of different problems or different concerns in mind that are influencing their design decisions.
Yeah, so this is actually a very interesting question, and I think that this is really where the whole Bitcoin versus Bitcoin Cash debate boils down to. The question is, if you do have centralization of mining power, does that necessarily put the network at risk? So if you read the original white paper, I believe that that what Satoshi was trying to actually say was that even if you had 90% of 100% of the mining power of Bitcoin centralized with one person, they still have an economic incentive to play the system right. Otherwise, the system will just fork, and they're left with a useless, bank of ASICs. So there are some people that believe that that's true, and there's also a very credible argument to be made that that can also be false, that you can have certain people that can censor in just the right way that you wouldn't even be able to know it's happening, and you wouldn't have the opportunity to punish them. So I think it's a fascinating question. I actually am not as much of a fan of designated proof of stake because you kind of have to know who the people that are designated are. So one thing that I like a lot about Ethereum's proof of stake is that it's literally just, if you have, and they're saying that it's going to be around 1,500 Ether, then you can become a staker. And I like that because you don't actually have to know who that person with 1,500 Ether is. It's literally just that account has plugged in and they're providing solutions. I think when you get to a designated proof of stake system, you're much closer to somebody actually campaigning, somebody trying to gain support, somebody asking for votes. They need to explain why vote for me, why am I good. I like regular proof of stake because it's literally like, I have 1,500 Ether. These are my answers. I have an incentive to be telling the right thing because my Ether would be worthless otherwise. I think that's a very good consensus model myself.
So I think that it's right. So the proof of work and I think proof of stake, most of the consensus protocols that I've seen look like they are designed to keep bad actors out. So I think that you're exactly correct. We need to understand what is the problem that we're trying to solve. So we could think that The problem is there are some good people and there are some bad people, and we want the bad people to not participate in the system, and we want the good people to participate. Alternatively, we could frame the problem as everyone is going to act in some way that varies from good to bad, and by providing the right incentives, we can encourage more good behavior among the people who are participating. So I think probably a little bit of both go into characterizing block producers themselves. But if the problem that we're trying to solve is keeping bad actors out, we want the system designed in one way. And if the problem is getting people who are participating to act in a more pro-social way, then the system should look different. So, I think, again, my judgment of the concerns that lead to these designs and trying to protect the blockchain from attack are that we might have someone who just is a nefarious person and wants Bitcoin to fail. And so providing incentives to that person to behave better won't prevent that person from attacking the system. I think that also it's important to keep in mind that centralized blockchains are one solution to this problem. If some authority is choosing who becomes a block producer and who does not, that's one way to deal with the potential of there being bad actors who could become block producers. And I think that there are probably a variety of systems we could build that fall somewhere between looking like a permissioned system and looking like a permissionless system. But it's unclear to me that the people, so the communities that are behind permissionless blockchains are concerned about a particular set of problems, such as censorship. And so it's unclear that some quasi-centralized system solves those issues.
Right. And actually, it brings us back to a question that was asked earlier about us replacing institutions with a new form of institutional governance. If it's entirely decentralized, there is no institutional governance. There is no institution. So we're replacing it with all of like the stakeholders, right?
I think that's not 100% accurate. So we talked earlier about how Bitcoin has had a hard fork. So there are people who are making decisions about what happens to the platform over time. There just aren't well-defined and agreed upon rules about how that decision making is going to be made.
Yeah, so this was a question about does there, as I understand it, does there need to be like two types of coins, like a coin like Ether and then like Ether gas? So like Neo has Neo and then there's also gas. And you pay for your transactions using this gas token. And as I understand in the case of Neo, the Neo token allows you to actually become or generate gas. I'm not completely sure about like how Neo is architected. I personally don't think it's necessary. I personally like the idea of simply having one token because, in my opinion, that allows much greater market efficiency. And you're either buying into the idea that Ethereum will be used when you buy Ether, or you don't believe it will be used. But in my opinion, that when you get things like, a system that has two different tokens, like a Neo and then like gas, I don't quite understand it well enough to know where to invest. Which one is the bet on the future of the platform, and which one is more like speculation? Like, I don't know about that.
So I think in the particular example that you're talking about, it's interesting that both coins are basically used for transactions. So one is a transaction, like a peer-to-peer transaction, and the other is a transaction between a person who's trying to trade and the entity facilitating the trade, so the transaction fee. So I think in that particular context, it does not necessarily make sense to separate those out into two coins. That being said, I think that we have seen examples where you'll have a platform that trade on the platform can occur in one token, and there's a separate token that's used specifically for governance issues. And I think that those could potentially make sense. They have two entirely unrelated uses, and it makes sense for the one that's used for transactions to be more liquid than the one that's used for governance. So I think that potentially separation could work, but it depends on the context. Yes.
Right, off of that, it seems like a lot of the tokens are talking about utility tokens, as we're seeing kind of security tokens and things getting regulated. In that case, would it be okay, would it make sense to have a security token to fund the development of the project, you get equity in that, then potentially if there's a useful case and a real reason why you need to have a token and grow utility, using that, and then also a different class of tokens for voting, so kind of having different tokens that serve certain purposes when it started at the security level and you're investing in that project and actually getting equity. Does that make sense?
Yes, it does. I think an important issue to note is that if you are starting a decentralized platform, it's unclear what one owns equity in, since you don't have control rights over the platform itself.
Not like a protocol, like a lot of the ERC-20 tokens were people who were, it was really insecure. They might have percentage of revenues or equity or things like that, not
Yeah.
necessarily at the protocol. More
Yeah.
so, does that make sense?
Right, yeah. So, yes. So the question was, could it make sense to have a separate token for utility, a separate token for security, and a separate, was the last one? Governance. Yeah. So, I mean, I think that, if we want to use the current stock market as a model, we should think carefully, should voting and equity be tied to each other? Maybe our answer is no, but that's basically the model we've been using for the past century, and there must be some reason why we have been using that model, I hope. So I think that's exactly the right question. So if we're saying that voting should be held separately from utility and from equity, then that's telling us something, like that's saying we think these decision makers should be different people than the people who are using the platform, and should be different people from the people who own the equity in the platform. I'm not sure whether there is a context in which that makes sense. Probably it makes more sense to have voting tied to one or the other, or both.
Yeah, I think that the utility tokens are very dangerous territory, personally, because it's not quite clear what the demand for some of these utility tokens will be if they're not being burned. So if you say that these utility tokens are being burned, so it'll be like always going down in supply, well, then it's very clear why there'll be like a demand for it. But if there's no burn element and that utility token is being like constantly just passed around, so does... Yeah, exactly. I mean, there's a lot of people that see sort of an issue, but like the difference is that people don't, like the US dollar, for example, is like a medium of exchange. It's a way to like simply like pass value. Yeah, you don't burn it, but it is being inflated. So like some of the best examples of security tokens that I really like and are very simple are for a lot of decentralized casinos. So they have, I love their contracts because they're so simple. Basically what they say is, this is a decentralized casino. It's a virtual slot machine. These are the odds of the house. It is a 1% odds. That money will be put into this pool right here. And we're going to have 100 million token holders, and that will be distributed amongst those 100 million token holders. Very, very clean business. Like, owning a token, I know exactly what I'm going to get. And then I can look at the volume that virtual slot machine is doing, and I can be like, okay, well, if it does this much volume because it has a good advertising campaign or something like that, well, I'm going to be making this much in terms of revenue. I like that system. That is very clear. I can explain to somebody how that makes money. But if I can't necessarily explain to somebody how a utility token that's never burned and always passed around, why that's a good place to put your money today.
Thank you very much for that last insight. Guys, this was a really interesting topic. Economics and governance, when we went into this, I was worried that, we wouldn't be able to make it like super exciting, but I think we achieved some excitement in this topic. Look, I hope all of you enjoyed this as well. We have a networking reception right now. I hope you will stick around. If you've got a drink ticket, please redeem it. And join us back again next Tuesday. We will have another exciting topic surrounding blockchain. If you have friends that are interested in this space, please do bring them along. And if you ever want to refer back to the discussions, we do post them both in our Telegram chat, which we are launching tomorrow, and as well as on our website. So before we adjourn, let's give our panelists a nice round of applause. So thank you very much, guys. Have a great evening and keep innovating.